Hi, this is the third video in our Chipotle analysis, and I plan to do two main things in this video. One is to basically start setting up the financial model, and in this one, we're pretty much just going to be entering data into a spreadsheet, historical data, and then I'm going to introduce a valuation model that might be useful as part of our overall analysis. So let's start with the Chipotle balance sheet. Again, remember this comes straight from the 10K. So the 10K is the annual report. Every company files these with the SEC, and you can get these from the company's investor relation pages, or a number of other sources have them as well. I usually go to the investor relations page from the company just because there's a lot of other worthwhile features there to look at. So here we have Chipotle Mexican Grill, and the first financial statement you'll see, as you can see, there's nothing above there, is the balance sheet. Now, one thing that I find somewhat interesting and a little bit disappointing on the balance sheet is that typically the financial statements show 3 years of data, except for the balance sheet, which shows 2 years of data. I like to have at least 3 years of data, preferably 4 or 5 years of data. Now, once you get beyond 5 years, it starts to get less meaningful, but having at least 3 years of data is pretty helpful for starting to see trends and patterns and things like that, which can be useful. So when I prepared my spreadsheet, one thing I did is this is the 2019 10K for Chipotle. I went ahead and got the 2018 10K because that gave me 2017. So then I had 3 years of data, 2017, 2018, 2019. And then I went to Excel. You can use another spreadsheet, but I imagine most people are going to have access to Excel. Google Docs or Google Sheets does this as well. And just started putting in the data. Now you can download a lot of this data. A recommendation that I've heard from other people and I think is really worthwhile is to go ahead and put it in by hand. And part of the reason for that is if you download the data, you're not really paying attention to what it is. If you're typing it in by hand, you'll actually see that. So even though the balance sheet is first, I start with the income statement. So just scroll down and you'll see the income statement. Notice the top line is revenue. So if we go back to 2017, that is 4,476,412. But note that's in thousands. So really that's roughly $4.5 billion in sales, $4.9 billion in sales. And then in 2019, they had $5.6 billion in sales. After that, you start taking out the expenses. So obviously one of the big expenses is going to be food costs. As you can see, their food costs have gone up each year. That's not surprising because their sales have gone up. Their labor costs have gone up each year. Occupancy costs, which is effectively the rental rates, other administrative costs, general and administrative expenses, depreciation and amortization. Now, this is going to be important when we get to our cash flows because depreciation and amortization is an accounting expense, but it's not a cash flow. So we're going to end up adding that back in later on. Pre-opening costs, impairment, closure costs, asset disposals. And so what I do in my spreadsheet is I just literally type each of those in, put in the heading, type each of those in. And it takes a little while to do this, so it's not going to be 2 minutes and you're done. If you downloaded it, it would take you 30 seconds to have these financial statements in there. But typing them in by hand, I think, allows you to get a better feel for the numbers. And you just want to be careful to double check typos. So when I get down to the net income line, I always check and make sure my net income lines up with what I'm seeing from the financial statements. And occasionally I'll have a situation where I transpose two numbers, so I go back and fix that. but that gives you a chance to make sure that you're getting the data down. And so I've got that with my income statement. I also have 3 years of data for the balance sheet. Again, all the information on the balance sheet. Now, one thing to point out on the balance sheet, and this is something I'll talk more about, but if you look at operating lease assets in 2017, that was zero. In 2018, that was zero. In 2019, it's $2.5 billion. Well, what's going on there? And what's going on there is an accounting change. So in the accounting rules, they changed the way they recorded operating leases. Used to be off balance sheet, now it's on balance sheet. So that makes a big change there. You can see their total assets jumped up dramatically, but also their total liabilities. So long-term operating lease liabilities jumped up here as well. And so that's part of the balance sheet. Remember, balance sheet assets equals liabilities plus owner's equity. If you have a big jump up in the assets, you've got to increase the liabilities or owner's equity. So it's more of an accounting measure, but it does change the way that we record things. Here we have a current operating lease with 0, 0, and now it's 173 million. And that is just, again, part of the accounting change that went on in that process. And I'm going to talk a little bit more about how I modeled that. I'm not going to say it's a perfect attempt to model it, but it does provide me some guidelines as to how it might impact cash flows going forward. If we look at statement of cash flows, you'll see statement of cash flow starts with net income. So it's basically starting with information from the income statement. You can see I've actually got a link here. So instead of retyping that net income, I just pulled it straight from the income statement. Same with the depreciation and amortization. Some companies don't break that down on their income statement. Chipotle does. So I just linked it straight from the income statement. Other adjustments to operating cash flows, and I'll talk more about that when I get into the modeling process. The net cash from operating activities just adds those three values up. So here we have our net income. Depreciation and amortization is not a cash expense, so we're going to add that back in. Other adjustments includes things like changes in receivables, changes in inventories, changes in accounts payable, all those working capital items, also some lease adjustments and things like that go into that. And so what we see is over the last few years, that's been a net positive for Chipotle. So Chipotle's cash flow from operating activities is quite a bit higher than their net income. And that's going to be important. You're going to see that in a lot of companies. And a big reason for it is the depreciation and amortization. That lowers our net income, but it's not a cash expense. Instead, the cash expense for that occurs when we're purchasing new equipment. And so our net cash from operating cash flows, and then we have cash flow from investing activities. So Chipotle's cash flows from investing activities includes a few key categories. One is purchases of leasehold improvements, property, and equipment. Essentially, when Chipotle opens a new restaurant, they have to create the restaurant there. So that has some cost. They don't purchase the land very often. Typically, that's leased, and that's where that leasing problem came in on the balance sheet. But they still need to build the building. Now, some restaurants use franchises. Chipotle owns most of their stores, so they're building the restaurant, and that ends up being cost. So every time Chipotle opens a new restaurant, that's a huge cash outflow for Chipotle, but it also is going to generate cash inflows. The more restaurants they have open, the more profits they make. As long as each restaurant is profitable, then building a new restaurant is going to improve their cash flows over time. Next, we see purchases of investments and maturities of investments. And one thing you'll notice is that these numbers kind of bounce around a little bit each year, But largely, and I'll talk more about this as we go through the 10K, what those are doing is basically just serving as a way for Chipotle to set aside some money. And as that money or as those investments mature, then Chipotle can take some money out. So it's kind of like a cash substitute. And so when we look at our free cash flows and we get into the modeling, the cash flows are going to ignore these purchases of investments and maturities of investments. Instead, we're going to just leave those as zero because Chipotle is going to spend money purchasing new investments, but they're also going to have a lot of investments mature. And so our assumption is that those are going to kind of balance out over time. Real quick, let me do something. Let's sum up the purchases of investments and the maturity of investments. And if you look over the last 3 years, this is pretty much just canceled out. There's no net increase there. So modeling that going forward, we're just going to assume those cancel out. They're not going to cancel out on a year by year basis, but you're not going to be able to say, well, in 2023, they're going to end up purchasing an extra 100 million. In 2024, they're going to have an extra 200 million mature. You're not going to be able to model that precisely, so we're going to ignore those. Proceeds from sale of assets, you can see that's a relatively small thing. We're going to assume that that just zeroes out throughout the rest of the process. So our big aspect here is going to be our net cash from operating activities and our purchases of leasehold improvements. The difference between those is going to be our free cash flow to equity. That's how much is available to shareholders. Now, that doesn't mean that's how much Chipotle is giving back to shareholders. Instead, they could be spending more to do other things and reinvesting those. Now, a lot of that reinvestment is going to come in this purchases here. So if Chipotle doesn't pay dividends, how are they returning that to investors? And one of the things we're going to see here is acquisition of treasury stock. So Chipotle has purchased shares back on a regular basis. They spent 285 million, 160 million, 190 million over the past 3 years, and that is effectively giving money back to shareholders. So acquisition of treasury stock is largely a way to return money to shareholders. Now, they could also be paying down some debt if they have debt, but Chipotle does not have long-term liabilities, so they don't have that going on. So their money returned to shareholders is going to go into acquisition of treasury stock, our purchases of investments. Those are going to be the two primary areas where that money is going to get returned to investors. And again, you can check these figures in your financial statements. Make sure for the statement of cash flows, you're getting the cash equivalents lining up everything. And that's a way to make sure that you're entering those numbers correctly. Now, I'm going to come back to this here. One of the things I want to stress is my valuation model is I'm very much a proponent of a stock represents a piece of a business. When you buy a share of Chipotle or a share of Apple or a share of General Motors or Tesla or any company out there that's publicly traded, what you're buying is a piece of the company. It's a very small piece of the company, but you're buying a piece of the company. And therefore, the value of the stock is based on the value of the company. So when I do my valuation analysis, what I'm trying to figure out is what is the company worth? And so I am going to look at the free cash flow to equity and convert that to a per share basis. So we're going to fill in these numbers in a later slide or a later video. But this is a model that takes these free cash flows to equity and converts them to a share price. This is another slightly different model. And I want to talk briefly about this model real quick, because what this is the H model. And the H model is a variation of the constant growth and non-constant growth. One of the challenges of discounted cash flow analysis is we need to come up with a terminal value. So for example, if I'm valuing Chipotle, I can forecast out what I think is going to happen the next year, 2, 3, 4, maybe 5, even 6 years. But Chipotle is not going to just stop business in 6 years or 7 years or anything like that. Chipotle intends to be a publicly traded company until they get taken private or until they go bankrupt or things like that. And I don't think they're planning to go bankrupt. So when we value stocks, we have to recognize that that stock doesn't mature. We have to value the present value of all the expected cash flows that are going to be generated from now through the end of time. And so we have to come up with some terminal value, because I might be able to say, well, I can reasonably think about what Chipotle is going to be doing in 2025 or 2026. Keep in mind, it's the summer of 2020 now. So that's looking out 5 or 6 years. But is it realistic for me to say, well, in 2043, I think Chipotle is going to grow at 4.5%? There's no way I have any idea if Chipotle is even going to be around in 2043 or what the world's going to look like at that point. So at some point, typically 5, 6 years out into the future, it makes sense to just assume some terminal value, what you think the company is worth at that point. And there are two basic ways to do that. One is use the constant growth model. That's introduced in pretty much every introductory finance course out there. It's just the next year's dividend divided by the required return minus the growth rate. However, a lot of companies are growing faster than normal right now, especially companies you might be interested in. And so if I look at Chipotle and say, well, maybe they're growing at 15% a year right now. And right now I'm just making that number up, but let's say 15% a year. It's not reasonable to assume they're going to grow at 15% a year forever. If they did, they would be bigger than the overall economy. And so I have to assume that that growth rate is going to slow down. And ultimately, it's probably going to slow down to whatever the economy is growing at. Now, you may even argue that it's going to slow down a little faster than that, because if you think a lot of growth in the economy comes from newer companies that are rapidly growing, so more mature companies are probably going to grow a little slower than the overall economy. So at some point, it's probably going to grow slower than the overall economy, but I don't know when that's going to happen. So what I might do is use something like the H model. The H model is used for a period of higher than normal growth, when the growth rate is expected to drop in a linear fashion over 2H years. H stands for the half-life of the supernormal growth rate. So here you can see a diagram. Growth is up here, maybe that's 15%, maybe it's 20%, whatever it's growing at. And I assume that over the next, let's say 10 years, that the growth is going to drop to 2 or 3%. This drop is linear, and that fits the H model. So the H model doesn't say growth is going to drop like this. It doesn't say growth is going to go up here and down. It doesn't say growth is going to bounce all over. Instead, what it says is growth is going to just gradually go down in a linear fashion over 2H years, or H is the half-life. And again, I mentioned the reason we don't assume growth forever at really high rates. Let's take Chipotle. Again, I'm just making these numbers up, but let's assume that Chipotle would grow at 20% per year for the next 50 years. Chipotle earned about $5.6 billion in revenues in 2019. So 50 years from then would be 2069, and they would be generating $51 trillion in revenues at that point. Just put that in perspective, that's 60% of the total global GDP for 2017. That was the most recent number I could find real quick. So if you think Chipotle is going to be generating 60% of all the income generated in the entire world in 50 years, then that might make sense. It's probably not going to happen though. So if Chipotle or any other company is growing fast now, that growth is going to slow down over time. We're not going to see a constant growth. So if you have an H model, the formula, and the formula looks kind of ugly, but with Excel, you plug a formula in. Once you get it set up, the numbers just automatically update the formula. So all you have to do is set this formula up once, just walk through an example. If the dividend is $1.50, it's growing at 15% today, has a required return of 9%, and is expected to see their growth stabilize at 3% in 10 years. The stock would be worth $34.93. And I put the numbers in here just so you could see that. I'd encourage you to go ahead and walk through an example of that. Just make sure you're getting the same numbers. And you can see here is kind of the constant growth, and here is that growth premium for the next 10 years where the company would be growing faster, and that gives us a combined value of $34.93. So going back to our spreadsheet, this is going to use the constant growth model to come up with a terminal cash flow. This is going to use the H model to come up with a terminal value. And that's going to be where we're going to head in our next video. We're going to talk about how we generate some of the forecasts, get the cash flows, and determine the value. Thanks.